Imagine it's the 14th of December 2001. You're a 43-year-old accountant living in Buenos Aires, Argentina. Your name is Carlos. You wake up at 6 in the morning in your two-bedroom apartment in the Palermo neighborhood, the same apartment you have owned for 11 years. Paid for with careful savings over a decade of steady work, you have 2 children in school and a savings account with $32,000. Your father always told you, never trust the peso, always save in dollars. You have a pension plan and a small investment in a mutual fund. You have worked hard your entire adult life. By the standards of your country, you are doing well. You are, by every reasonable measure, safe. You make your usual coffee and read the newspaper. The headlines are tense, but they have been tense for months. You tell yourself what you have been telling yourself for 2 years. The government will fix it. They always do. Argentina has been through hard times before. If you have ever wondered why some families walk out of an economic collapse with almost everything, while others lose everything overnight despite doing all the right things, stay with me. What you're about to hear is not a theory. It is a pattern. It has repeated itself across 5 continents over more than 100 years of economic history in countries rich and poor. It happens in countries stable and chaotic, and it always ends the same way. For those who knew the pattern, life continued. For those who did not, the damage was permanent. If you find value in this kind of historical clarity, subscribing takes 2 seconds. It keeps you ahead of what most people never see coming. Now back to Carlos. 3 days later, on December 17th, 2001, the Argentine government announced something called a corralito. That word means little fence in Spanish. What it actually meant was that Argentines could no longer access their own bank accounts. Withdrawals were capped at 250 pesos per week. Within weeks, the peso was devalued so severely that those 32,000 US dollars Carlos had saved in good faith were converted to pesos. This happened at a government-mandated rate that wiped out more than 60% of their value overnight. Carlos had done everything right. He had saved. He had diversified. He had even chosen foreign currency. And yet, the system took more than half of everything he had built. This video is about the one decision that saved families in every major economic collapse of the last century. Not the obvious decisions, not the panicked decisions people make when the crisis is visible on the front page, the quiet, boring decision that separates those who rebuild from the people who spend years trying to recover what they lost. History has a pattern, and once you see it, you cannot unsee it. Before we go further, there is something important to understand about how economic collapses actually work. Most imagine them like earthquakes. Sudden, unpredictable, a single violent event that comes without warning and destroys everything. But that is almost never how it actually happens. Economic collapse is more like a building where the foundation has been eaten through by moisture over years. The walls look fine. The paint is fresh and the lights work. And then one day, someone walks across the floor and the whole structure drops. The event everyone remembers, the bank run, the currency devaluation, the stock crash, that is not the cause. That is the moment the building finally admits what it has been for a long time. This distinction matters enormously, because if collapse were truly sudden and random, there would be no pattern to study and no lesson to learn. But because collapse is a slow process with a fast ending, there's always a window. There's always a period, sometimes years long, where the people who are paying attention to the right things can make the one decision that changes everything. Economists call this systemic fragility. Think of it as a game of Jenga where someone has been quietly removing blocks from the middle. Everyone at the table keeps playing as if nothing has changed because the tower is still standing. The mechanism at the heart of almost every major economic collapse in history is the same. It is the gap between promises and delivery. It is the gap between what the financial system promises and what it can actually deliver. Banks promise that your money is safe. Governments promise that the currency will hold its value. Pension funds promise a steady income in retirement. These are promises built on assumptions. And when the assumptions break, the promises break with them. The people who survived these moments were not necessarily those who predicted the timing. They were the ones who had quietly stopped depending on those promises before the promises were broken. This brings us directly to the first case study, and it is one of the most instructive economic disasters in modern history, precisely because it happened in one of the most prosperous and stable-seeming economies in Asia. The year is 1997. The place is Thailand, then South Korea, then Indonesia, and then Malaysia in rapid succession. What history calls the Asian financial crisis. It was not a single event, it was a cascade. And it began, as most cascades do, with something that looked like success. Throughout the late 1980s and early 1990s, Southeast Asia experienced what economists called the Asian miracle. Growth rates of 7 or 9%. Rising middle classes and modern cities being built faster than the rest of the world could keep up with. Foreign investors poured money in. Returns were extraordinary. Thai banks, Indonesian corporations, and South Korean conglomerates all borrowed heavily in US dollars because interest rates were low. They then lent that money out in local currency at higher rates. As long as local currency stayed stable, this was profitable. But it was also a trap. In early 1997, currency speculators began testing the Thai baht. The baht was pegged to the dollar. The Thai government had promised to maintain a fixed exchange rate, but that promise required enormous dollar reserves to defend. On July 2, 1997, Thailand ran out of the reserves it needed to keep that promise. The baht was allowed to float. Within a year, it had lost more than 50% of its value against the dollar. Now every Thai bank owed twice as much. Corporations that had borrowed in dollars suddenly owed twice as much in local currency terms as they had before. Businesses that were profitable on Monday were technically insolvent by Friday. The same collapse spread to Indonesia. In Indonesia, the rupiah lost 70% of its value. In South Korea, the government was forced to accept a bailout. They accepted a $58 billion emergency bailout from the International Monetary Fund, the largest in history to that point. For ordinary Indonesians, this meant watching the price of rice double in months. For ordinary South Koreans, it meant mass layoffs. Export companies collapsed under the weight of dollar-denominated debt they could no longer service. The unemployment rate doubled within a year. In Indonesia, an estimated 100 million people were pushed below the poverty line. These were not poor countries before this. These were countries that had been celebrated internationally as models of development just 2 years earlier. And yet, within the wreckage, some families came through largely intact. In South Korea, there was a particular group. These families and small business owners had kept a portion of their savings in gold, not because they predicted the crisis, but because in Korean culture, gold had historically been treated as a separate category of wealth, something kept outside the financial system. When everything denominated in Korean won collapsed, gold held its value in dollar terms. It was an old habit that saved families. This leads to the second part of this story, requiring us to travel to a place and time many know but few understand. Think about this. When you imagine an economic collapse, you imagine a country that was already poor or unstable. But what if the collapse happened in one of the wealthiest and most educated societies on earth? A country that literally rebuilt itself from rubble into an economic powerhouse in less than 40 years. Drop your answer in comments. What I'm about to show you next is the part of this story that most people never hear. It changes safety, understanding. The country is Japan. The year is 1991. The story actually begins in the mid-1980s when Japan was the most envied economy. Japanese companies were buying American landmarks. Japanese real estate was so valuable, the Imperial Palace land was worth more than California. The Nikkei stock index had risen 400% in the decade between 1981 and 1989. Japanese banks were the largest in the world by assets. Japanese workers had lifetime employment guarantees. The future, from inside Japan in 1989, looked like an infinite escalator going up. Then in January 1990, the escalator stopped. The Bank of Japan raised interest rates to try to cool what was privately acknowledged as a speculative bubble. Asset prices began to fall, at first, slowly, then faster. By 1992, the Nikkei had fallen from 39,000 to 17,000. Commercial real estate prices in Tokyo fell by more than 60% over the following years. They did not recover quickly. Japan's stock market in 2003 was still down 75% from its 1989 peak. It took the Nikkei until 2024, 35 years later, to fully recover to its 1989 high. A Japanese saver who put retirement savings into domestic stocks in 1989 waited 3.5 decades to get back to zero. For Japanese families, the damage was compounded by a cultural belief in lifetime corporate employment and government-backed pensions. Suddenly, they found themselves in a world where those promises were hollow. Companies began laying off permanent employees. Banks that were too big to fail were allowed to fail. The government bailed out some and let others collapse. There was no clear pattern that ordinary people could follow or predict. The families who came through with wealth intact were different. They were not the ones who had bet on stocks or property. They maintained what is called the Tanshin Funinshi habit. This was a portion of household wealth kept completely separate from investment vehicles and liquid, accessible, non-correlated assets. This meant postal savings accounts, physical cash held at home, and gold, not glamorous or high return. When the financial architecture collapsed, these separate pools of simple value became the difference between rebuilding and starting over. Now here is where it gets interesting. The Japan and Asian crisis stories show a pattern, but the third study is extreme. The place is Cyprus. The year is 2013. Cyprus was a member of the European Union, using the euro with full Western regulations. In March 2013, the Cypriot government agreed to something never done before in a Western nation, a bail-in. In a bailout, the government rescues the bank. In a bail-in, the bank rescues itself by taking money from its own depositors. Accounts holding over 100,000 euros were subjected to forced losses of up to 47.5%. Depositors did not choose this or vote for it. They woke up, and nearly half their savings were gone. The savings were converted into equity shares in a bank that was widely understood to be nearly worthless. Business owners holding operating cash found themselves technically solvent, but practically unable to function as their money was taken. The Cypriot economy contracted by 5% and continued to shrink, while unemployment nearly doubled to above 16%. And yet, once again, within the wreckage, some families and businesses survived with far less damage. The ones who had kept cash or assets in foreign accounts before the crisis, not for any illegal reason, but simply because they had never fully trusted any single institution with all of their wealth, found that the bail-in took only what was inside the Cypriot banking system. What was outside remained outside. Most people will never know what you now know. Most people will keep trusting systems they do not understand, assuming that because those systems have not failed yet, they cannot fail. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in the textbooks. Now observe what all three of these cases have in common. Thailand, 1997, Japan, 1991, Cyprus, 2013. 3 different countries, 3 different decades, 3 completely different causes on the surface. Currency speculation in one case, real estate bubbles in another, banking overexposure to sovereign debt in the third. And yet, the underlying mechanism is identical in every single case. In each country, the financial system had made promises that the underlying reality could not support. In Thailand, the promise was a stable currency. In Japan, the promise was perpetually rising asset values and permanent employment. In Cyprus, the promise was European banking safety guarantees. And in each case, when the gap between the promise and the reality became impossible to hide any longer, the system adjusted by transferring losses from the institutions that had made the promises to the individuals who had trusted them. That is not an accident. It is the logic of the system. When a financial institution fails, the losses have to go somewhere. The question, every single time, is whether those losses land on the institution itself, on the government, or on you. And historically, the answer follows a predictable order. First, the institution tries to absorb the loss quietly. Then, the government absorbs some of it publicly. Then, when neither of those is sufficient, what remains lands on the depositor, the pension holder, the saver, the ordinary person who trusted the promise. The pattern becomes impossible to ignore when you lay all 3 cases side by side. The people who lost the most were not the least careful. They were often the most careful by the standards their society had taught them. Carlos in Buenos Aires saved in dollars because everyone said dollars were safe. Japanese retirees invested in Japanese stocks because for 40 years that had made them wealthy. Cypriot depositors kept money in European regulated banks because those were supposed to be the safest banks in the world. The careful, responsible, conventional choice was the one that broke their savings. The people who lost the least had made a different kind of decision. Not a smarter short-term bet, not a brilliant prediction of timing, but a structural decision made years before the crisis to hold a portion of their wealth in a form that the system could not reach when the system failed. This is where the story gets deeply human and deeply uncomfortable, because the people who got hurt the most in every single one of these collapses were not the wealthiest or the poorest. They were the ones in between. In Argentina, after 2001, the wealthy had already moved significant portions of their assets offshore years before the Corralito. Many had accounts in the United States, in Uruguay, and Switzerland. They lost something, but they did not lose everything. The poorest Argentines, who had nothing in the banks, to begin with, lost almost nothing from the banking collapse specifically, though they suffered enormously from the inflation and unemployment that followed. The middle class, people like Carlos, the accountants and teachers and small business owners who had saved responsibly and kept their savings exactly where the system told them to keep them, in local banks, in pension funds, and government-approved savings vehicles, they were the ones who were most exposed when the system failed. The professional middle class lost the most because they had the most to lose, and the least structural protection. In Japan, the same pattern played out over decades rather than overnight. Japanese middle-class savers who had concentrated their retirement wealth in domestic equities and domestic real estate saw their net worth hollowed out over the 1990s in what economists now call Japan's lost decade, though in practice it was closer to 2 lost decades. Japanese pensioners found that their defined benefit pension promises were renegotiated downward as the corporations and municipalities that had made those promises found themselves unable to fulfill them. The people with professional salaries, who had diversified only within Japan, who had stocks and bonds and property all denominated in yen, and all subject to the same underlying collapse in Japanese asset values, discovered that diversification within a failing system provides almost no protection at all. You can have 20 different kinds of savings in one country, and if that country's financial system fails, all 20 of them fail together. In Cyprus, the bail-in specifically targeted account holders above the 100,000 euro threshold, which meant it hit the savings of successful professionals, small business owners, and retirees who had accumulated savings over a lifetime of work. These were not speculators. These were not people who had taken risks. These were people who had done exactly what financial advisors, governments, and banking systems had told them to do for their entire adult lives, and the system took nearly half of it. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the survivors do differently? The historical record is remarkably consistent across every one of these events, and it does not require predicting the future. It does not require knowing which country will have a crisis or when. It requires understanding a structural principle, and then acting on it before urgency removes the option to act at all. The first characteristic that survivors shared across Argentina, Japan, Cyprus, and every other major economic collapse of the last century was what historians of personal finance call the split principle. They did not keep all of their wealth in the same type of asset, and they did not keep it all inside the same system. This is different from conventional diversification, which typically means having some stocks, some bonds, and some cash, all of which are claims on the same underlying financial system. The split principle means holding some portion of wealth in assets that exist outside the financial system entirely. Physical assets whose value does not depend on a promise from an institution. In Korea during the Asian crisis, this was gold. In Japan, it was cash held outside the banking system. In Argentina, it was foreign currency accounts held in countries with different systems. In Cyprus, it was assets held in foreign jurisdictions. The specific form varies. The principle is the same. The second characteristic was liquidity. Not investment performance, not yield, not growth. The people who came through collapses with the most intact financial lives were the ones who could access real purchasing power quickly without depending on any institution's cooperation. When Argentine banks locked their doors in December 2001, the people who had cash at home or gold or assets in another country did not need the banks to cooperate with them. They had purchasing power that did not require anyone's permission to access. The survivors had positioned themselves so that the cooperation of the financial system was optional for them, not required. The third characteristic is the one most people find hardest to accept. The survivors had made their structural decisions in advance, during calm times, before there was any obvious urgency to do so. This sounds simple, but it goes against every human instinct. During calm times, the cost of maintaining a split structure feels real, because you are foregoing returns by keeping some wealth in lower yield, non-productive forms. The benefit feels theoretical, because nothing bad is happening yet. Human psychology is almost perfectly designed to reverse this calculation. We feel the certain cost of preparation sharply and the uncertain benefit of protection vaguely. And so most people wait. They wait until the crisis is visible, and by then, the window has almost always closed. Argentine capital controls were announced with minimal warning. Cypriot banks were closed on a weekend with no advance notice to depositors. Japanese asset values fell for years, but the decision to exit at the top, which required recognizing the top while still inside it, was one that almost no ordinary saver was psychologically positioned to make. The historical record shows that those who came through these periods largely shared three characteristics: structural separation of at least some wealth from the domestic financial system, prioritization of liquidity, and access over yield and growth for that separated portion, and the decision to establish that structure during times of apparent stability rather than waiting for visible warning signs. This brings us back to Carlos in Buenos Aires in December 2001. What actually happened to him is not a dramatic story of genius or foresight. It is a story of the particular combination of decisions he had made before the crisis. Carlos had, because of advice from an uncle who remembered an earlier Argentine crisis in the late 1980s, kept roughly 15% of his savings in actual physical US dollar bills stored at home. Not in a bank account, not in a financial product. Physical cash in a foreign currency held outside the system. He also owned his apartment outright, with no mortgage, which meant the bank crisis could not take it from him through foreclosure. His pension fund lost significant value. His bank account savings were partially wiped out by the conversion. He suffered. He lost years of progress. But because of those two structural facts, the physical dollar savings and the owned home, he had a floor beneath him that the crisis could not reach. He had purchasing power during the crisis when other families in his building had nothing. He was able to help his children continue their education. He was able to maintain a basic standard of living through the worst months. He rebuilt within 3 years. His neighbors, who had trusted the system completely, are still, decades later, catching up. The lesson of Carlos is not that he was clever, it is that his uncle's advice, rooted in lived experience of an earlier Argentine crisis, had structured his financial life so that the system's failure was damaging but not catastrophic. The knowledge of the pattern, not the prediction of the timing, made the difference. This is historical and educational analysis. It is not financial advice. Every individual situation is different, and the specific assets, jurisdictions, and strategies that make sense for any individual depend on their personal circumstances, their country's laws, their tax situation, and 100 other factors that only a qualified professional can assess properly. Please consult a qualified professional before making any financial decision. What history can offer is not a prescription, it is a mirror. It shows you what has happened to people who did certain things and to people who did not. What you do with that reflection is entirely your own decision. This video is not for everyone. Most people will dismiss it. Most people will say, that was Argentina, that was Japan, that was Cyprus, that is not my country, that is not my life. And they may be right. But some people will recognize something in this history, a pattern that looks familiar, a structure in their own life that perhaps deserves a second look. If one person in your life needs to hear this story, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.